As much as I don't like hyping up any fund, every time I see a negative comment about WPAY, I take a step back and run through the strategy again. And what I keep finding is this: no matter what the critique is, from a strategy standpoint, WPAY consistently comes out ahead. You can talk about leverage, you can talk about distributions, but one thing you really can't ignore is the simple fact that the weekly pay ETFs, the foundation that WPAY is built on, have shown in a very short period of time that they can track their underlying stocks almost perfectly. In many cases, they've even outperformed. That's something covered call ETFs just don't do. In fact, with traditional covered call ETFs, especially the ones that write on 100% of their portfolio, the pattern is clear. They are almost always destined to lag their underlying stock, even when you factor in distributions. That structural drag is baked into the strategy. WPAY, on the other hand, doesn't have that same limitation. Covered calls have been popular because they promise steady income. You own the stock, you sell calls against it, and you collect the premium. But here's the trade-off. The moment the stock takes off, your upside is capped. You've basically sold away your future gains in exchange for today's income. That's the structural flaw. Covered calls can never keep up with their underlying in a sustained bull market. WPAY flips that model on its head. Instead of selling calls and limiting growth, it gives investors 120% exposure to the weekly moves of the stock. That means it fully participates in the upside, uncapped, while still delivering weekly distributions. For a stock like Nvidia or Tesla, where growth is the story, this makes a huge difference. On income, covered calls deliver premiums that are relatively stable but modest. WPAY's distributions, on the other hand, are tied to amplified stock moves. In bullish weeks, that can translate into significantly higher payouts than covered calls could ever provide. It's dynamic, not capped. Now, volatility is the big question. Covered calls cushion the downside because premiums offset losses. WPAY doesn't. It's 120% exposed, so yes, losses get magnified. But for investors who are bullish and who believe in the long-term trajectory of their stocks, that volatility isn't just risk, it's opportunity. Let me break down what I mean by opportunity. First, amplified upside. With covered call ETFs, your gains are capped. You only get to keep a slice of the move because the calls you sold limit your upside. WPAY has no such cap. That 120% exposure means when Tesla, Nvidia, or Amazon rips higher, WPAY captures the full move and then some. Volatility fuels those sharp price jumps, and WPAY turns them into outsized profits. Second, bigger weekly income. Remember, WPAY's distributions are tied directly to those weekly moves. More volatility, more action in the stock, more potential income flowing to shareholders. Covered call ETFs are limited to distributing the option premiums they collect. The problem is, most of the time, they end up paying out more than they actually earn in premiums. That shortfall gets pulled straight from the fund's capital base, which is the primary reason NAV erodes over time. Why do they do this? To keep the illusion of juicy yields alive and satisfy investors who don't realize how unsustainable it is. But it's a losing strategy. You cap your upside by selling calls, then over-distribute to cover for weak income generation. And even if you pulled in, say, 5% in premiums last month, the fact that you dipped into NAV means you're left with less capital to generate premiums with in the future. That's why many fund managers subtly push reinvestment, because without it, the math simply doesn't work. At the end of the day, it's just an inferior model. And finally, better entry points. Volatility creates sharper dips. For long-term believers, those dips aren't disasters, they're opportunities to add. And because WPAY doesn't cap your upside every time you buy low, you're setting yourself up for a much larger payoff when momentum turns around. So while covered calls frame volatility as something to be cushioned or avoided, WPAY reframes it as the engine of opportunity, amplified gains, stronger income, faster compounding, and more attractive buying opportunities. Now here's something important to consider. WPAY is naturally built for bullish markets, and history shows that's the environment we spend most of our time in. Since World War II, the average bull market has lasted about 5 to 6 years. The longest one, after the 2009 financial crisis, went on for more than a decade. Meanwhile, bear markets are much shorter. They usually run 9 to 18 months, sometimes even less. The COVID crash lasted just a few months. So the pattern is clear. Bull markets outlast bear markets by 4 or 5 times. That's why WPAY's structure makes sense. It leans into growth with leverage, so yes, downturns hurt more. But in the long stretches of upside, it captures and amplifies gains in a way covered call ETFs just can't. That's the trade-off. And if you line it up with market history, WPAY looks far better positioned for building wealth over the long run. Personally, I love picking stocks. But the thing about WPAY is, it's already done the heavy lifting for you. This ETF has hand-picked companies that are well positioned for growth over the next several years, some of the market's strongest growth drivers. You're talking about names like Nvidia, Tesla, Microsoft, Google, Apple, Amazon, and AMD. These aren't random picks. Each of these companies has proven growth catalysts and a track record to back it up. Nvidia is leading in artificial intelligence and GPUs, powering everything from gaming to data centers. Tesla continues to dominate EVs and is investing heavily in autonomous driving artificial intelligence. Microsoft benefits from recurring revenue through cloud services, Office, and enterprise software. Google keeps growing search, YouTube, and cloud while exploring artificial intelligence opportunities. Apple has a sticky ecosystem of hardware and services that supports consistent revenue. Amazon goes beyond e-commerce. AWS, logistics, and advertising are major growth engines. And AMD is gaining market share in both CPUs and GPUs with strong growth in gaming and data centers. These are the companies that could move your portfolio over the next several years, and WPAY gives you access to them in one package, leveraged. So, if your goal is long-term portfolio growth while collecting uncapped income along the way, WPAY gives you exposure to the companies most likely to increase in value over the next several years. You're getting access to some of the strongest growth engines in the market, all in one fund. So, to wrap this up, these are the main reasons why I'm leaning heavily toward WPAY. It's almost a no-brainer compared to most, if not all, covered call ETFs. I continue to hold WPAY in my portfolio, along with a select handful of their single stock weekly pay ETFs where I have high conviction. So far, everything has been performing as expected, and I have no complaints. It's one of those funds that makes it easy to stay invested in high-quality growth names while also collecting consistent income. If you found this breakdown helpful, drop a comment with your thoughts. Make sure to like, subscribe, and turn on notifications so you don't miss the next deep dive. I'll see you in the next one.